Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all you have to hit thumbs up and subscribe. Questions, comments, put those below. First and foremost, wanted to thank everybody on this, that's been following this channel since we started in 2016. We just hit 3 million cumulative views over the course of the history of this channel. So 3 million views. Thank you so much for all your continued support. And, really, I think we're ultimately just getting going. Hoping to, again, create this as the go-to channel on, Canadian housing and macro in the Canadian landscape. So I wanted to touch on this week, obviously, the elephant in the room. Feel like we're beating a bit of a dead horse, but you can't not talk about Canada's most recent inflation print, update to the housing data on a national level, and some policy updates as well. So, first and foremost, Canada's CPI inflation coming in at 5.1% on a year-over-year basis. This is the highest reading since 1991. Good reading, but yeah, highest reading, 5.1% since 1991. Enjoy. And, this is obviously pales in comparison to the U.S.'s CPI print, which is just over 7% now. The one reason is Canada's CPI index actually doesn't include used car prices. And if we fire up the chart here, we can see, well, hey, used car prices are up quite a bit. So, a convenient omission on the CPI print from the Canadian government there. But again, we know that CPI inflation has been running, 5%. I would argue, again, well north of that, maybe closer to the U.S., maybe even higher, depending on who you ask. But you've got a situation where, to no surprise, when you expand Canada's M2 money supply, when you expand the amount of loonies in circulation, when you expand that by roughly 25% over 2 years, you've basically printed of all the currency in circulation. If you grow that by 25% in a span of 2 years, you could potentially argue there's going to be somewhat of a correlation there, or at least a debasement of sorts. And the Bank of Canada's balance sheet, having expanded over 300%, now owning 40% of the government bond market, massive fiscal deficits, this MMT, politicization of Canada's central bank. Lo and behold, we've got inflation breaking out. You factor that in with supply chain dynamics, and we've got really just a utter mess. And that kind of leads me to the shelter component, because the shelter component of CPI, bear with me as we throw up this chart here, shelter component is now at 6.1%. So shelter inflation in Canada is growing per Stats Canada just over 6%. Again, keep in mind, if you look at the orange bar there, it's really showing that that weighting comes down. So it would arguably be higher, because that weighting comes down because it does not include, or it does include, mortgage interest costs, right? So because people are taking out lower rate mortgages, that forces that debt serviceability. It actually eases that debt serviceability for those that are already in the market. For those that are out of the market, tough luck on that front. Because what we're seeing on the resale front, again, when you drop rates to effectively zero, and you expand the balance sheet and pump a whole bunch of liquidity in the housing market, sure feels good, but it sure doesn't feel good, again, if you're on the outside looking in, because national home prices up 28% year over year in January. 28%. I mean, that's just like an unbelievable number. 28%. The fastest pace of home price inflation on record. And this is really widespread. Let's just read this out here. You've got Canada at 28, so Toronto up 33% year over year, Montreal 15%, Vancouver 18%, Calgary, God bless Calgary, up 11% on a year over year basis. So the debasement is widespread. And funny enough, I was actually chatting with a couple big developers in Calgary. This is the nice thing of having a network that's just starting to expand across Canada is, you have conversations with them, and you're always kind of trying to figure out what's happening in various markets. And so what's you're actually seeing, the Calgary condo market, for example, has been relatively quite soft over the last 3, 4, 5 years. And interestingly enough, is there's actually all these pre-sale projects are now selling out in Calgary as a result of Toronto investors have actually been flooding that market, quite literally flooding that market and snatching up all these pre-sales. Basically what you have is a situation in Toronto. They have these pre-sale investment brokers or realtor brokers that exclusively focus on pre-sales. We call them like whale brokers. And basically what they do is they have a network of investor clientele, and then they basically just put the slide deck together and say, hey, this project, that project, and they basically sell these buildings out almost entirely. And so what they're doing is they've been putting pitch decks together on Calgary, a couple of years behind my thesis there, but they've been putting pitch decks together on Calgary and basically selling out that market. Now I will say, small caveat here, I do not buy pre-sales like condos in Calgary. The Calgary condo market is not like the Toronto and Vancouver condo market. Okay, there's plenty of land. The demographics and the cultural preferences around housing supply is much different. Okay, if you want to invest in Calgary, I typically do not recommend condos. They just don't do anything. They don't appreciate like they do in Vancouver and Toronto. Obviously, they offer pretty good cash flow, but keep that in mind when you're moving forward. But really what I highlight here is again this capital just kind of sloshing around. You're seeing widespread price appreciation, and this is again really a result of the overall arching thesis, which is, listen, this is a currency debasement. I would highly encourage you to go check out Ray Dalio. So Ray Dalio, Bridgewater, the largest hedge fund. He's put together a really good book that he just launched, but he's taken excerpts of that and put it on LinkedIn. And he just wrote a piece, really just highlighting, and he points out, he talks about housing, right? At the end of the day, it's like the house that you got that just went up, 28% across Canada nationally. Like, it didn't get any better. It didn't get any bigger. The land that it's sitting on didn't grow. It's the same. It's the same amount of real estate. It's just, your cash isn't buying you what it used to. And so, despite shelter inflation showing 6%, the resale market's up 28%. And the most concerning part of all of this is that month over month, if you actually unpack the data a little bit further, month over month, national home prices are growing at 3% a month, 3%, which basically tells you that the problem is actually getting worse. It's not getting better. If home prices are accelerating by 3% a month, it tells you that you're going to see higher prints here moving forward. So I would be less concerned if the price growth went from, 3% month over month to, next month it's 2.5 to 2 to 0.5, and seeing a deceleration in home price growth. You're actually seeing an acceleration right now. And, I would argue that that benchmark is partially a lagging indicator. What we're actually starting to see now, very early days, starting to see boots on the ground, a ever so subtle softening, or not softening, like a subtle slowdown in the detached housing market, particularly out in the suburbs. So you're seeing a subtle slowdown in that market. So hopefully this is the start of more listings coming on in the spring and seeing some of those bidding wars coming off. It'd be much better, I think, for everybody's sanity. But the interesting thing enough is that I've been getting in some debates recently with people on Twitter and journalists, and we just had. So keep in mind that I just denoted to you guys that national home prices are growing at 28%. I would call this a national emergency. The federal government, this week alone, the same week the print came out, announced that they're increasing their immigration targets. So they're now aiming for 1.3 million new residents to bring into the country over the next 3 years. So they're actually increasing the immigration targets with really no solution, no plan in place to house these people. I don't know where they're going to go. Last I checked, that the government and policymakers have quite seriously failed to house the existing population. So, ramping up immigration targets, supply cannot react fast enough. You guys have to understand that I'm in this space. I work in this space day to day. It's my job to know it. It takes the time you acquire a parcel of land, and you go through a rezoning and you build a condo building. That's like it's a 5-year play. That's a 5-year play. So, like, ramping up immigration targets, I think personally, again, Canada's built on immigration. We obviously know it, that we need it to keep it going, but ramping it up at a time when you have an unbelievable housing crisis rippling throughout the country, record housing shortage supply, is mind-blowing. But again, so I'm factoring that in. I think that, we're going to need to continue to build and add more housing, despite, housing currently being under, record number of housing units under construction, trying to keep pace. The problem is, and I was trying to explain this to a journalist, is like, at the end of the day, the biggest factor here is that you've got a global sovereign debt bubble, that you have a bond market that's valued at $30 trillion, just over $30 trillion. So you've got a bond market that's just valued just over $30 trillion, roughly 17 trillion of which is negative yielding, nominal negative yielding returns, bonds. But the yield on those bonds is $17 trillion worth of negative yielding debt. That's all looking for a home because central banks have basically destroyed price discovery in the bond market. You have a $30 trillion asset class that needs to go into alternatives because it's basically being guided there, right? And that's why you're seeing, record highs, more and more money, capital flowing into the stock market, more and more capital, pension funds, etc., going into real estate. And that's why obviously the crypto space is growing as well. Everyone's seeking a return. And so, like, you could argue that, real estate has basically become like a modern day savings account. I mean, same thing for dividend paying stocks. I mean, these are like the modern day savings accounts because you can no longer earn 3, 4, 5, 6% on GICs, and let alone government bonds, which is the single largest asset class in the world, $30 trillion. And so I said, listen, it doesn't matter how many more townhouses you build here, so long as real mortgage rates are running at -3%, -4%, you're going to continue to get an overwhelming amount of capital. You won't be able to build fast enough or quick enough to keep up with this capital coming into the market. Now, again, so the only way, in my opinion, to really fix housing is that you're going to have a higher interest rates. You have to have basically higher interest rates and some pain, which comes through a price correction. Basically, mortgage rates shooting up to 3.5%, 4.5%, and pushing prices down 20%. That's how, that's really the only way to affordability, but nobody wants that. It's the joke that Rick Roll made the other week is that everybody wants affordable housing, but nobody wants their house to become affordable. So this is the dilemma that we're ultimately tricking and fooling ourselves, that adding another 10,000 condos to the market is going to fix the problem. I mean, what you'll probably see by doing so is you'll see the price growth naturally, instead of growing up 28%, it would have gone up 23%. Because so long as all you have to do is look at global property prices and seeing that everyone's suffering the same fate. Why are global property prices ripping to all-time highs across the world? Well, it's because the cost of capital is essentially zero, and you've eliminated a $30 trillion asset class, and so that capital has to come out and flow into alternative, higher risk assets, such as housing. So that's my rant for today. As always, I hope that helped. This should come as no surprise here. My personal view moving forward is I do think that we are probably nearing a peak here in inflation. We'll probably start to see those year-over-year numbers start to decelerate. So keep that in mind. That probably will come. But I think structurally the damage has been done. This was, as expected and as I talked about several years ago, this has been, and has been the largest wealth inequality policies over the last 18 to 24 months. And it pains me, it hurts me to say that. But again, if anyone is watching these videos, we certainly tried to explain what was going on, and certainly tried to help people make decisions for themselves to protect their hardworking capital. Because again, your home, your net worth, while maybe up 28%, because your real estate's increased, at the end of the day, your purchasing power has ultimately been eroded. And so we have to keep these things in mind. You have to look at the bigger picture and start, running figures on real interest rates and real adjusted returns to see if you're actually keeping up in today's monetary debasement. So, as always, hope that helped. See you next week.